Assalamualaikum everyone. Based on the earlier discussion, we see that the sale price or the selling price was established based on the facility amount of the Murabaha plus the profit margin. And the profit margin is acquired from the facility amount multiplied by the profit rate per annum multiplied by the tenure, and that will give us a sum of $50,000. And when we add on that to the facility amount, the selling price of the Murabaha facility is $550,000. So that is actually what we have covered earlier. We want to look much closer to the profit rate of the Islamic Bank that will be consisting of the base rate or Islamic base rate that was actually, quoted in the product disclosure sheet, IBR of 3%, that represents the overnight policy rate. So the Islamic base rate is based on the conventional base rate that is using the OPR or overnight policy rate of 3%. And again, we see that the profit rate is set based on the interest rate, right? So the benchmarking is based on the interest rate. So interest rate has been used as a benchmark to price the Murabaha or to set the profit rate. And that is a contentious issue that has not yet been answered effectively by the academics. But what I see here is that the reason why the profit rate is set based on the interest rate is simply because the Murabaha, whether artificial Murabaha or commodity Murabaha, they essentially do not assume what I call ownership risk. There is no ownership risk. There is no business risk because for both Murabahas, we see that the Islamic Bank do not incur any risk in their balance sheet. For artificial Murabaha, the bank do not put the asset on their balance sheet, and for commodity Murabaha or Tawaru, yes, the bank put the CPO on their balance sheet, but the value of the CPO remains stable because the prices of the CPO, from the MPA and MSA was compromised. It was, there's some kind of coercion or arrangement to make the price of the CPO for MPA and MSA to be equivalent, so that will help to stabilize the price, the value of the CPO. So that to some extent tells us that the risk in the artificial Murabaha and the risk in the commodity Murabaha are simply financial risk, right, or credit risk, right? There is no element of business risk, and therefore because that business risk does not exist in the Murabahas, so it is logical that these Murabahas can be, the price of which can be benchmarked against interest rate, because interest rate, the risk is only related to credit risk or financial risk. However, if the Murabaha contains or carry business risk or ownership risk, then the risk profiling of this Murabaha will not be identical to the risk profiling of the loans, interest-bearing loan, and thus it's not a good idea to benchmark the true sale Murabaha, against the interest rate. So that has been the position that I see to be logically acceptable because the risk in the artificial and commodity Murabaha are very similar to the risk in the loan, interest-bearing loan, and that's why the profit rates of those Murabahas can be set based on the interest rate of the interest-bearing loan. So we will go from the spread, which is the profit rate based on the credit rating of the borrowing party, to the determinants of the spread, right? So we are actually benchmarking the profit rate based on the cost of fund, right? So when we are talking about benchmarking of profit rate based on the interest rate, we are referring to the first component of the profit rate, which is the base rate. So the Islamic Bank uses the OPR as the base rate to price their product, but the spread is a component of the profit rate that is independent from the base rate. Yeah, so the spread can be internally controlled by the bank, whereas the base rate is controlled by the regulator. Okay, so that is why we look here that we want to see in more detail what is the nature of the spread and what actually influenced the spread, what actually influenced the second component of the profit rate, and that is the spread, which is actually the credit risk premium. So a premium is an increase, right? So the increment is coming from the riskiness of the borrowing party. So the spread is one component of the profit rate that is derived from the credit rating of the customer or the credit worthiness of the customer. So let us see a bit closer what are the determinants of the spread, right? And meaning that what are the factors that determine the size of the spread, right, or the amount of the spread. And we can just look at the so-called the assessment of credit rating, and that can be basically derived from two main credit rating system. One is the 5 C's of credit, and the other one will be the FICO scoring, right? So we want to see, that one component of the profit rate is the spread, but what is the factor that is determining the amount of the spread or the size of the spread? And that would be based on the system of the 5 C's of credit as well as the FICO scoring. So the 5 C's of credit is common knowledge in credit risk management. And when bank, is looking at prospective borrower, so in order to ensure that this potential borrower have the capacity to pay the debt over time, so there is a loan assessment or loan evaluation to be undertaken, and that loan assessment is basically based on a system of credit assessment, and that is the 5 C's. Right? So the 5 C's of credit are a framework that lenders use to evaluate a prospective borrower's creditworthiness or credit rating to determine the loan rates and the terms, right? And of course, we look at the loan terms, meaning that the loan, is it a long-term loan, is it a short-term loan, is it a loan with collateral or without collateral? So that kind of determinant will be impacting the spread that will be charged to the profit rate. So these the 5 C's of credit are the character, capacity, capital, collateral, and condition, and we will try to look at them in very briefly. And character will be the borrower reputation, that is the credit history. So we want to see how well the borrower is able to pay off his debt, and the credit history will show whether this borrower is a procrastinator, or whether he have problem in the past to pay off his loan, and that will define the character of the borrowing party in terms of how well he is able to pay his loan, whether he will pay it on time, or he will always take time, or make delay payment, or make last minute payment, and that will define the character of the borrowers. Capacity is the borrower net cash flow or income and asset that will define how strong the borrower is able to pay back his debt. Right? Net cash flow would be cash in, cash out. So net cash flow. So there must be a positive net cash flow to provide confidence to the bank that this customer have the capacity to pay, and his income and salary will also help to ensure that he can pay up his debts, and what kind of asset that he will be having, that can generate future income for him to pay off his debt obligation to the bank. Capital, again, is the amount of money that the borrower has to pay off the down payment. Or for a business company, how much capital the bank how much the bank possess, in order to smoothly operate the business. Collateral is asset the borrower pledges as security for the loan, such as property, deposits, as well as securities. So collateral is one of the main factor that will determine how well you will be able to get the loan approval. So the more collateral, the more money that the bank will be able to recover upon default. And condition will, of course, be the purpose of the loan, the economic condition, and other external factor that could impact repayment. So again, to what extent the loan will be used in business, and that business should be able to generate profit, so that the company will be able to pay back their debts, right? So what will be the economic condition during which the loan is approved? That is a very important factor to reckon with. And again, we are also looking at the external factor, that can influence the performance of the company, and that external factor is very, very critical to provide the bank some level of confidence that the borrower is able to pay off his debt obligation. So what we will see here, that this information from the 5 C's of credit can be used by the bank to calculate what we call the expected loss of the loan facility. And this expected loss is a model that is based on few variables, such as the PD, or the probability of default, the exposure upon default, meaning that upon default, what is the outstanding balance of the loan, and then the loss rate given defaults, and that would be the loss to the bank when the default event occur. So this expected loss need to be estimated based on the information gathered from the 5 C's of credit. And once the expected loss has been estimated, that will determine how much spread that will be charged to the Murabaha facility. So the interest rate or the profit rate will be the sum of the base rate, which is controlled by the regulator, and the expected loss that will be under control of the banking company. So this is essentially, how the profit rate is determined at the banking level, and this is essentially a very important ingredient in pricing of loan and pricing of Murabaha. So guys, thank you very much. I'll see you again next time.